Is big tech dead? That is the question that's on every investor's mind right now. And today in this video, we're going to take a look at the 3-year historic returns of Facebook, Apple, Amazon, Microsoft, Google, and Netflix, of course, known as FAMGA, or whatever acronym it goes by today. And we're also going to look at the valuations of these companies. But before we get into it, please, if you like what we have to say, give us a like on the like button. If you haven't subscribed to our videos, please smash that subscribe button. It helps us get our content out to the rest of YouTube viewers. So everyone knows what's been happening in big cap tech. We've had a big sell-off to start the year. Interest rates are going up. Investors are worried about Jerome Powell and inflation and possible war with Russia and Ukraine. So let's take a look at big cap tech, how it's traded over the last 3 years, and then we're going to go over some simple valuations to help you make better decisions on where to put your money. Now, what I want to say about this is whenever you have something that becomes an acronym, okay, because in the past we've had the BRICS, which was Brazil, Russia, India, and China. After that, we had the PIGS, Portugal, Ireland, Greece, and Spain. I almost forgot my Southern European countries. And those were the hot real estate markets before the housing crisis. And then those were trouble spots after the financial crisis. So let's look at what's happening in FAMGA recently. And I want to pull up this chart of the 3-year return of Meta Platforms, which was formerly known as Facebook, Apple, Microsoft, Netflix, Amazon, and Google. And you can see this chart dates back 3 years ago. Can't believe that was 2019, 3 years ago, February 2019 to today. The biggest winner out of all of these is Apple. It's up 300%. The one, I wouldn't call it a loser, but Netflix is only up about 25%. And second place to last is Meta Platforms, which is up about 45% in that time frame. And then if you got Amazon, which is just about equal with Meta Platforms. Right here, you've got Alphabet up about 150%, Microsoft up a little under 200%. And again, the big winner over the last 3 years, believe it or not, has been Apple, has been really leading the charge. It's a $2 trillion company now. So after we've seen what these companies have done in the past, what's important is where they're going in the future. And one way to look at that is to look at their growth rates versus their current valuations. And this is a simple rule of thumb that can tell you whether or not a stock is expensive or it's cheap. And let me just pull up this table right here. What we've charted, thanks to my analyst, Steve, is basically the price earnings ratio versus the 3-year growth estimate in their earnings. Okay, so very simple. A price earnings ratio is the price of the stock divided by what the expected earnings are this year. And that line is in blue, is this blue table. Now, the orange line is the 3-year compounded annual growth estimate. So for years 2021, 22, 23, and 24, this gives you how quickly their earnings are expected to grow over the next 3 years. So this is a simple way to look at their growth rate. Now, a lot of these companies have different accounting valuations. For instance, Amazon doesn't necessarily report earnings in the same way that Apple does. But this is a good, simple overview of the FAMGA sector to show you where their PEs are right now versus their 3-year growth estimates. And when you look at this, the cheapest one right now from a PE perspective is Facebook. And this trades at about a 17 times PE. The most expensive one is Amazon. And this trades right around a 60 price earnings multiple. But what's important here is where their price earnings ratio is in relation to their growth. So if their price earnings ratio is below their growth, then the multiple has room to go and match it. The price earnings should be roughly around how quickly the company is growing, because the price earnings is basically a valuation on what investors expect their earnings to grow in the future. So what's really interesting is that from this perspective, Amazon looks like it's the most overvalued because the PE is ahead of their growth rate, whereas Netflix, Microsoft, Google, and Facebook are all below. Apple is also has a PE ahead of their growth rate. But what I find most interesting is that Facebook, after the sell-off yesterday, is a huge wide range between here and their expected growth rate. And I think what investors are thinking is that some of the issues that Facebook had in the last quarter, whether it be because of the Apple privacy laws, which stopped allowing Facebook to collect data on users and then sell it to advertisers, and also the emergence of TikTok as a competitor to Facebook. So instead of spending, hours a day on Facebook, a lot of the younger generation is now using TikTok. And so that's caused the valuation of Facebook to come in lower. And the growth rate is still up, but I think investors are expecting this to fall a little bit. So that is why Facebook is trading at a significant discount to where its growth rate is in comparison to the rest of the FAMGA sector. So given the overview of this, I don't think that the price earnings ratios of FAMGA is wildly overvalued, because the S&P 500 is right around 23. So Facebook is below the S&P 500 price earnings ratio. Google is a little bit above, same with Apple. Microsoft is about 10 points higher, Netflix about 15 points higher. And then of course, Amazon is 2 to 3 times higher, but Amazon is growing very rapidly. As if you look at this growth rate here, just around 20% compound annual growth in their earnings. So that is just a good overview of where things stand in FAMGA. I don't think that this is going to start a secular bear market in the space because of how quickly their earnings are still expected to grow in the future and how their valuations, are significantly in line for the most part with the S&P 500. So that's it for this week's YouTube. I want to thank everyone for tuning in. Any comments, hit us below. We'll be sure to get back to you, and we'll see you next week. Thank you.